Alright guys, these are just some additional practice questions about fiscal policy and understanding if you know what it is. Alright, so pause it when you want, and I'll try to explain things as best as I can and try to fill in some gaps. So number 8 here says, an appropriate fiscal policy to combat a recession would be to increase which of the following. Alright. So without kind of knowing anything about these other things like interest rates, that kind of stuff, well, if you increase interest rates, people will invest less. That's not going to stop a recession. The money supply, if you increase the money supply, that doesn't necessarily, it couldn't necessarily increase or combat recession. It would just mean that there's more money out there. Taxes. Okay, an increase in taxes would decrease aggregate demand, and so it's got to be D here. So government spending increasing would be the only thing that would combat a recession. Okay. So an increase in personal income taxes will most likely cause aggregate demand and aggregate supply to change in which of the following ways in the short run. So an increase in personal income tax, would mean that consumers have less money to spend. So your aggregate demand is going to decrease. So it's going to be C or D. Aggregate supply isn't going to be affected by personal income tax, but business taxes. So aggregate supply isn't going to change. So it'd be C. Which of the following combinations of changes in government spending and taxes is necessarily expansionary? Alright, so government spending would need to increase. We know that, right? If it's expansionary, we're expanding the economy, government would increase. So it's going to be either A or B. And taxes is the tricky one. If you decrease taxes, that's going to increase your aggregate demand. So it's got to be B. 21 here, with an upward sloping short-run aggregate supply curve, an increase in government expenditures let's graph it out. Okay, this is going to be a bad graph. I'm using my mouse here. It's not bad. Okay, supply, demand. Pretend that says aggregate supply, aggregate demand. Don't have to label all the things, right? So an upward sloping short-run aggregate supply curve, an increase in government expenditures, let's be an increase in aggregate demand, so boom. Well, price level went up. Okay, so the answer would be C. Alright, price level increased, but we'd also have an increase in our GDP down here. Next, which of the following are most likely short-run effects of an increase in government expenditures? So remember, the word expenditures means spending. All right, so an increase in government spending is what they're saying here. Okay, so which of the following are the most likely short-run effects of an increase in government expenditures or government spending? So hopefully in the short run, unemployment rate would decrease. We would hope that the inflation rate would stay low, but actually what's going to happen is an increase, and GDP would also increase. Be C. If the government increases expenditures on goods and services and increases taxation by the same amount, which of the following would occur? This is a tricky one, and I bet they'll have a question like this. Remember, if the government increases expenditures, that's going to affect the spending multiplier because they're spending on those goods and services. All right, an increase in taxes, all right, you would think would do the opposite thing. But if that MPC, and we're assuming, is going to be the same, their marginal propensity to consume is going to be the same. Remember, people often save more. So in that case, it's going to be B. I don't have a ton of room to write here, so I'm not going to say much, all right? And if you have questions on this, come and find me. But the graph above shows aggregate supply and aggregate demand. They just do this to kind of throw you off. They're really just going to ask you questions about aggregate demand here. So you see this perfectly, what we call perfectly elastic aggregate supply. They're just talking about what's going on here. All right, so the graph above shows aggregate supply, AS, and aggregate demand curves for an economy. Calculate the spending multiplier if AD shifts to AD here as a result of an increase in government spending of $100. So I'm just going to throw up the rubric for it and let you guys kind of work through, and if you have questions, let me know. All right, peace out.